While most people have been staring at homeowners and wobbling Zillow estimates, the real action has been happening where it always happens first, inside institutional balance sheets. And right now, one of the loudest warning sirens in American real estate is coming from the most powerful private equity machine on the planet, Blackstone. This is not a story about one bad deal. It's a story about what happens when Wall Street takes a sector that looks inevitable on a slide deck, loads it with leverage, underestimates operations, and then discovers too late that demographics don't pay your bills. Cash flow does. Blackstone's senior housing bet is the first fracture. The single-family rental model is the second. Put them together, and you're looking at a single connected narrative. Cheap money built an empire, and expensive money is forcing that empire to make decisions that ripple straight into the housing market regular families live in. Let's start with the piece. The Wall Street Journal put under a spotlight in November 2025, Blackstone's $1.8 billion senior housing gamble, about 9,000 units, now being unwound at losses exceeding $600 million. That number matters because it's not a rounding error. It's not mark-to-market volatility. It's a full-scale reversal of a thesis that was sold as nearly unbeatable. The silver tsunami, the aging of the baby boomer generation, the idea that demand was guaranteed. In 2016 and 2017, Blackstone went on a major buying spree. They paid roughly $1.1 billion for 64 communities from HCP and about $747 million for at least 25 properties from Welltower. This wasn't dabbling. This was buying network scale 9,000 units across the country. And like most large institutional real estate moves, it wasn't just buy and hold. It was the classic formula: buy, improve, stabilize, sell. The journal described it as buy it, fix it, sell it. But senior housing isn't a normal real estate asset class. It's housing, hospitality, healthcare compliance, staffing, food service, and family trust all in one. It's an operating business hiding inside a property deed. The journal captured that complexity through an industry quote. It's like buying an apartment inside of a hotel, inside of a restaurant, inside of a medical clinic. And when you buy an operating business, the building isn't the main problem. Execution is. Then the world changed. The pandemic hit senior housing especially hard. Occupancy dropped, costs rose, regulations tightened. Operational errors stopped being issues and became value-destroying events. Blackstone reportedly applied more than $100 million in upgrades and changes, but many assets still ended up sold at steep discounts, sometimes more than 70% below purchase price. The journal's analysis of public records found that for a set of 39 properties sold between 2022 and 2025, Blackstone paid around $755 million and sold for roughly $536 million, about a 29% haircut, before you even count the extra money sunk into improvements and carrying costs. And here's the part that turns bad deal into system signal: the financing. Blackstone financed those senior housing deals with around $1.2 billion in debt. And the journal reported that loans for about 24 of those properties entered special servicing and alarm bell in commercial real estate. That basically means this loan is stressed and needs intervention. In plain English, rising rates didn't just hurt valuations. They squeezed cash flow. Floating rate debt and higher costs turned what looked like stable income into a monthly fight. So Blackstone did what institutions do when a thesis breaks and financing tightens. They started selling. That sell-off matters beyond senior housing because it changes how the entire market prices risk. It changes how lenders write terms. It changes how pension boards evaluate safe real estate allocations, and it changes how every competitor, every allocator, every regulator, and every rival fund manager thinks about the next deal. Now let's connect it to the housing market people actually argue about at dinner. Single family rentals. Blackstone has played in single family housing for years. They built invitation homes in the post 2008 era and later re entered the space through other vehicles. In June 2021, Blackstone's Bright announced it would acquire Home Partners of America, valuing it around $6.0 billion. The pitch wasn't complicated. In a world where homeownership was getting harder, rentals, especially single-family rentals, looked like the new, stable asset. Institutional capital loved the story. Steady cash flow, inflation hedge, housing is a necessity, and rent checks that keep coming whether the stock market is up or down. The Wall Street Journal covered that broader institutional trend too. Wall Street betting billions on rental homes, positioning single-family rentals as a major investment theme. And for a while, the model looked bulletproof. When rates were low and home prices were rising, you could buy homes, rent them, refinance, and repeat. As long as financing stayed cheap and rent growth stayed strong, the machine worked. But here's the hard truth. When you institutionalize housing, you also institutionalize its vulnerabilities because the model depends on a handful of variables you do not control. The cost of money, insurance costs, property taxes, maintenance, labor, local regulations, the spread between rent growth and expense growth, and the one variable that kills any landlord faster than headlines ever will. Vacancy. When rates jump, the cost of capital goes up. When insurance spikes, especially in storm-heavy states, the expense line moves whether you like it or not. When property taxes reset after price run-ups, you pay the bill. When contractors are scarce and labor is expensive, your light renovation turns into a backlog. And if rent growth slows or reverses, you don't get to negotiate with math. Now, the text you provided uses dramatic claims, internal documents, tens of thousands of homes sitting idle, specific occupancy collapses, specific write-downs. I can't responsibly present those as confirmed facts without a reliable named source showing those exact numbers. What I can do is sharpen the argument into something stronger. A disciplined, evidence-grounded narrative that doesn't need exaggeration to hit hard. Here's what we know from credible sources and from Blackstone's own public messaging. Blackstone emphasizes that institutional ownership of single-family homes is small, and it argues that institutional purchases have fallen sharply since 2022. In Blackstone published fact sheets, they claim institutional acquisitions dropped to a very small share of total home sales in 2024, and that large owners were net sellers. Now, you should read those claims with the right mindset. It's the firm defending itself. But even as a defensive document, it tells you something important because it signals what the incentives are right now. If institutional buyers want you to believe they're not moving markets, it's because they know the political and regulatory climate is heating up. And it is. In January 2026, the Wall Street Journal reported on a political proposal framed as a crackdown on housing investors, something that helped trigger a sell-off in shares of big rental firms and even hit Blackstone, which owns a single-family home landlord. That is the key point. Regardless of your view on institutional landlords, the risk environment has changed, rates changed, politics changed, regulation risk increased, and when risk rises, big money either demands a higher return or it backs away. This is where the senior housing disaster becomes a window into the single-family rental story, because the lesson is the same in both worlds. A spreadsheet is not a moat. If your model assumes stable financing, stable costs, stable occupancy, and stable public sentiment, you are not investing. You are betting that nothing changes. And things changed. Senior housing exposed the operational complexity problem. Single-family rentals exposed the scale problem. When you own a handful of homes, a vacancy hurts, but you can hustle, adjust, repair, negotiate, and survive. When you own tens of thousands spread across multiple markets, your vulnerability is different. Small percentage changes become massive dollars. A vacancy rate that moves a few points isn't a few empty homes. It's thousands of empty driveways, thousands of work orders, thousands of leasing incentives, thousands of months of lost rent. Scale magnifies losses the same way it magnifies returns. And that's before you factor in this. The market is no longer one directional. The pandemic era trained investors to believe demand is endless and prices only go up. That mindset is dead. The reality now is choppier. Some metros cool while others stay tight. Some neighborhoods get oversupplied. Some see insurance shocks. Some see tax reassessments. And rates can hold higher for longer than anyone wants. So when you hear single-family rentals are recession-proof, understand what they really mean. They're trying to sell you stability in a system that is no longer stable. Now step back and look at what happens when Blackstone, an institution with over $1 trillion under management, takes a major public loss in one real estate segment. It doesn't stay isolated. The consequence is not Blackstone collapses. The consequence is behavioral. More conservative underwriting, more skepticism toward operating heavy sectors, more pressure to show liquidity, more attention from regulators, more cautious acquisition targets, more selling in markets that no longer pencil out. And when institutional buyers pull back, the housing market feels it, not everywhere equally, not overnight, but in the very places where institutional activity was concentrated and where pandemic-era pricing got stretched. Sunbelt metros, high-growth markets, places where rent growth forever became an assumption instead of a question. This is the connection most people miss. Institutional buyers don't just compete with you on your offer. They shape the entire ecosystem behind your offer. They shape how much inventory exists, how many homes get renovated versus deferred, how many homes are built as rentals, what appraisers see in comps, how lenders perceive risk in certain zip codes, how quickly sellers expect a deal to close. So when they change behavior, when they become net sellers, when they tighten standards, when they shift capital away from certain categories, regular buyers finally get something they haven't had in years. Oxygen, more inventory, less competition, more negotiating leverage. But there's a second edge to that sword, and it's the part a serious buyer has to be honest about. When institutions sell, they don't do it gently. They do it according to fund timelines, debt maturities, investor redemption pressures, and risk committees. That can increase price volatility in the exact neighborhoods where they own the most. In other words, the same thing that creates opportunity can also create local downturns. If you're a buyer, you need a grown-up strategy. Buy based on time horizon, not hype. Stress test your budget for higher rates and higher expenses. Focus on neighborhoods with real end-user demand, not just investor demand. And treat discounted inventory like a tool, not a temptation. Now let's bring it to the deepest point in your combined script, the moral argument. Housing should be a home, not a commodity. That line hits because it's emotionally true for a lot of people. But if you want to make this sharper and smarter for a male audience, you don't lean on emotion. You lean on incentives. Here's the incentive reality. Wall Street doesn't buy homes because it hates families. It buys homes because the system let housing become a financial instrument. Cheap leverage, scalable property management tech, institutional credit, and investors begging for yield. The betrayal isn't one company. The betrayal is that we built a system where the most important asset in most people's lives, their home, became a line item in someone else's portfolio optimization. And when the portfolio needs to de-risk, the people living inside the assets don't get a vote. That's why this story matters. Because senior housing showed the lie of demographics guarantee returns, and single-family rentals show the lie of scale guarantees stability. What guarantees stability is simple and unglamorous. Cash flow that survives higher rates, operations that can handle real-world stress, costs that don't explode faster than income, and a model that can survive political and regulatory scrutiny. Now here's the final turn, the one that makes this not just a warning, but an advantage. There are two types of failures in investing. Thesis failure. The core idea was wrong. Execution failure. The idea might be right, but you ran it badly. Senior housing demand is still real. People are aging. Families still need quality care. The silver tsunami didn't vanish, but Blackstone's experience shows that demand exists is not the same as profits are guaranteed. Single-family rentals are also not dead. People will always rent. The question is whether the returns justify the risk in a higher rate, higher cost, higher scrutiny world. And that's where the market is going next. Capital will move toward whatever delivers better risk-adjusted cash flow with less operational chaos. Sometimes that will be multifamily. Sometimes it will be build-to-rent communities where maintenance is centralized. Sometimes it will be niche residential strategies. But the common theme is simple. Wall Street will chase efficiency. And when Wall Street pivots, it leaves behind two things: distressed assets that specialists can fix, and openings for regular buyers who finally aren't competing against unlimited capital. So what does this mean for you? It means stop watching the market like a spectator and start watching it like a strategist. Watch who is selling. Watch where inventory is rising. Watch where institutional demand used to be the tide and where that tide is pulling back. Because the next phase of the housing market will not be decided by individual homeowners alone. It will be decided by institutions choosing what they can no longer justify holding. Blackstone's senior housing unwind is not just a headline, it's a signal. And the single-family rental era is not guaranteed. It's being tested by rates, by costs, by politics, and by reality. That's the lesson. Not that housing is unsafe, but that too many people stopped asking the only question that matters in any market. Who is really in control? And what happens when they have to sell?